to get back to sort of what we consider to be more of a fair value level, you'd have to see the S&P 500 fall back towards 5,000 compared to it being at 6,000 today.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Stock market valuations remain high by nearly every valuation metric. And what concerns today's guest is that the earnings estimates being used to price stocks today seem far above what the free cash flows of the underlying companies will be able to deliver. In short, stock prices appear to be promising returns that their actual profit growth simply can't meet. We'll discuss this concerning disconnect today with Chance Finucane, Chief Investment Officer at Oxbow Advisors. We'll also address the other big trends factoring into his portfolio allocation decisions right now. Oxbow Advisors is a financial advisory firm founded by Ted Oakley that specializes in the needs of high net worth clients. As Ted's CIO, Chance will share with us what kind of market outlook the firm sees ahead for the rest of the year and how it's positioning its clients' assets today for it. Chance, thanks so much for joining us today.
Hey, Adam, it's great to be back. Thank you.
Pleasure to have you on here. We have Ted on from time to time, and we need to have you on more, so I appreciate you taking time out of your busy schedule of both managing all the portfolios there at Oxbow, but also running around after a 14-month-old young boy. Congratulations on that again.
Yeah, no, thanks. It's been a really fun year so far.
All right, well, you look way too rested for a guy with all that on his plate, but I'm glad for it. So look, I got a lot of questions for you. A lot of them are based off one of your recent market updates that you published there at Oxbow. I know you also are working on one that's going to come out soon after this one. When that one comes out, Chance, you guys have been kind enough to let me share that with the Thoughtful Money audience. So folks will do that again when the latest report comes out. But anyways, a lot of questions to dig into with you here, Chance, especially on valuations. Very quickly, though, if we can just kick things off with the intentionally broad question I like to start these discussions with. What's your current assessment of the global economy and financial markets?
Sure. So just looking at things from the very sort of base level, we always start with sort of just what's the risk-free rate? What can we make with taking out anything on the risk curve? So right now, you're still looking at a higher than 4% short-term treasury rate. It's way better than what you could have gotten 4 or 7 or 10 years ago, and allows you to maintain your purchasing power in a world that is 3% inflation right now. So it's nice to know you've got that as a starting point. And then when you start thinking about where you can try to take risk in a smart way, if you look at the US stock market, we just had 2 really good years for US stocks. And what we're seeing is that valuations are high. And if you take a 5 or 10-year outlook like we like to, the starting point that you're at today would suggest that your expected returns are going to be definitely lower than the historic average, and you need to be mindful of that. We also think it's not taking into account the increased uncertainty and volatility that's being put into place under the new presidential administration, just in terms of not knowing where policies are going. And where you can see that is with since the election results in November, you had this big pop over the course of a couple of weeks where you saw small caps go up by 10%, you saw home builders peaking, you saw transport stocks doing well. That's all reversed now in the last few months and is really starting to go the other direction. And I think that shows that under the surface, there's more uncertainty beginning to be priced in. But in terms of the total index level, it's still holding up. So for us, we're really trying to focus on smartly taking risk. And then the last piece is internationally. What we notice both domestically but also overseas is inflation accelerating and a little bit of better growth than what we saw last year in some of these overseas markets like in the UK, Europe, China, and just an improved rate of change in growth and inflation is a positive for commodities. And for our high income strategy, that's been an area we've been sure to have a 25 to 30% allocation in companies that have exposure to different commodity markets. And we think that's an important place to be in the year ahead as well.
Okay, those are great jumping off points. I want to ask you about each one of those. Maybe we can start with valuations kind of getting ahead of themselves. Pulling up some of these charts here again from your recent market outlook. So this chart here that you guys had shows basically the delta between stock price appreciation that we've seen in recent years versus growth in free cash flows. And you can see here, to your point, stocks have just been far outrunning the growth in free cash flows, which are correlated with earnings. And stocks are theoretically, or not even theoretically, they're supposed to be priced based on earnings. And so you look at this and you think, okay, so a lot of the stock price appreciation over the past several years has been multiple expansion. Is that justified or not? What would your answer be?
We would say it's not sustainable. And I think you had a period there through the 2010s and the early 2020s where, on average, the free cash flow yield of the US stock market was about 5%. If you wanted to flip that ratio and think about it like a price to earnings ratio, it would be like saying the price to free cash flow of the market was about 20 times. And that was always about fair value to us. But that 5% free cash flow yield is now less than 4%. And to get back to sort of what we consider to be more of a fair value level, you'd have to see the S&P 500 fall back towards 5,000 compared to it being at 6,000 today. And that doesn't mean that it's got to come down tomorrow. It just means that if this is your starting point and you're just investing in an index, there's a lot of positivity and optimistic forecasting already in that price, obviously coming from the high hopes of AI and some of these tech companies that could be beneficiaries of that. And maybe that all comes to fruition. But right now, it seems to be priced like it's a certainty. And what we've been trying to do is still put together a portfolio that's more like that 5% free cash flow yield that we think is more reasonably valued and also has less downside. That you're not going to have the same risk of a big earnings miss against expectations like you have with some of these industries and companies that some are already going through it, and then others were worried may have significant misses to come.
Okay. We're going to talk in a bit about your allocation, but what I'm sort of taking from what you're saying here already is, look, the stocks measured broadly seem to be overvalued for the reasons that or richly valued for the reasons that you just mentioned. We'll talk in a moment that a good chunk of that's because of overconcentration or high concentration in the stock market. Big tech AI is pushing an awful lot of that. And it sounds like you're saying, look, there are pockets of better relative value in the market, and that might be where the gains are going forward, which this would echo what some other recent guests on this channel have said, which is a more active approach is probably going to yield better results in a year like this year versus just riding the passive side, which the past 2 years, that's been a winning strategy. I want to pull one more chart from here quickly that you mentioned earlier, where you said starting at these rich valuation levels, mathematically, that makes it harder to have better returns over the next decade, because if you are starting from a very overextended valuation, you've pulled a lot of tomorrow's value already into today. So, really, that needs to be worked off. And I guess the question I have for you is, we've got this chart here that's basically showing when PEs are this high, subsequent 10-year returns tend to be flat or even negative. We can get there just by going sideways for 10 years, or we can get there by having a lot of volatility, right? Some big up years, some big down years, but lo and behold, 10 years from now, you look back and you say, well, we didn't really make a lot of progress. Do you favor one route versus the other in terms of probability?
I would say, I mean, logically, you would think, oh, we'll just trade sideways for 10 years or 5 years until we get back to sort of a normal valuation, and then you can go back to an 8 to 10% return every year in the stock market. But I'm sure you've seen those data points where if you look back the last 100 calendar years, it's something like only 10 to 15% of the time that the stock market actually delivered that 8 to 12% return that it averages historically. The sentiment of investors and just changes in forecasts, whether it's in economic growth or in industry and company growth, that drives these huge swings in the stock market in terms of prices. And so our expectation, we don't know if the next move is going to be further up like the past 2 years, or if we're going to go through a correction or a bear market first, but we would anticipate volatility throughout the next 5 or 10 years. And right now, you need to wait for the next opportunity to have a better pitch if you're sitting at the plate waiting for something to come through that you think is really priced at a great level for a 5 or 10-year investment.
Okay. And again, maybe I'm stealing from the punchline from later on in the discussion here, but with an outlook like that, does that mean that you guys are still allocating, you're still playing within this market, but does it mean that you're being a little bit more conservative than normal, meaning not just maybe picking some of these lower valuation stocks, but maybe also holding on to a little bit more cash reserves or a little bit bigger percentage in things like T-bills, so that if indeed there is a downdraft, you have some dry capital to deploy at better valuations?
Yeah, absolutely. So in our long-term growth stock strategy, we've got about half in stocks and then half in short-term treasuries. In our high income strategy, which is the other portfolio that's in has an allocation to riskier asset classes, it's a similar approach where it's about half in safe treasuries and then a half in allocated into things that have a little bit more risk to them, but we think we're taking smart risks and trying to generate an outsized return. And two ways to think of it. One would be there's very little out there that's really undervalued. If there's something that looks really undervalued when everything's been up the past 2 years, it probably means there's something truly wrong with that company or that industry. And there's all sorts of examples we could jump into, but that's usually not the place to go. And so what we're trying to do is find things that we think are reasonably priced. You're not stealing it, but you think you're catching it at the right time in the cycle, and you think the downside is low. So if you miss a little bit on your estimates, the risk of a break is only maybe 10 or 15%. It's not 30 or 40%. And you give yourself an opportunity to get an outsized return if you're right and things really come together in a good way. So to give an example of something like that, just within consumer staples, we primarily have been focused on the household and personal care industry because that gets away from the risk with GLP-1 drugs and people trying to be healthier, and also some risk with tariffs with the alcohol and spirits companies, which is one of those industries that looks really cheap right now, but there's good reasons for it. But if you just look at the packaged food area, it's not an area that we're really looking to go into, but two companies that we think are significantly different right now. We did a small investment recently in General Mills. Not exciting. It's trading at 13 times earnings. But if you look through the history of the company, they very rarely have much of an earnings miss. So you can get a 4% dividend yield. They'll grow their cash flow about 5% a year over time. We're just trying to get a little bit extra return on top of that risk-free rate without taking too much risk. Compare that to Hershey over the last couple of years. Good company, well run through its history, but they just guided down. Their earnings are going to decline by 34% this year from last year. So if you thought that you could just ride this like it was a compounder for year after year, it cut in half over the course of 2 years, which is significant for a space that you think is supposed to be really safe. So that's the type of thing we're really trying to focus on, companies that if we're wrong, we miss small and still have an opportunity to keep either holding it for longer or reallocate without taking much of a loss.
Okay. Well, it makes total sense. So you said that, so it sounds like, yes, you're being a little more conservative than you would be in a market you felt more optimistic about.
Yes.
Did I hear you right that even in your growth fund, you are still about half T-bills right now?
Yeah, yeah, that's correct. So when we've been,
Sorry, just in your answer, if you could include, if this was a market you felt really excited about, what would your T-bill percentage normally be?
yeah,
Zero, somewhere in between? Where would that be? Yeah.
yeah, I was just gonna mention. So at times like the end of 2018 or March of 2020, when you did have a bear market and valuations got really attractive, that cash level has fallen down to 10 to 15%. And so to be at 50 right now for us tells you where we think things are at.
Yeah. Yeah. Okay. All right. Well, look, you said earlier too, look, valuations are just rich versus cash flows, right? Underlying earnings growth. So that's sort of a big warning sign in and of itself. But then you said there's other things that you don't think, other risks that you don't think the market is taking into consideration. And you said you mentioned some of the uncertainty of obviously the new administration, and I want to ask your opinion on that in a bit. But you also mentioned inflation. So inflation has been stickier than obviously the Fed has wanted, and it has been at least measured by CPI. It's continued to creep up over the past 6 months or so, so heading in the wrong direction. And of course, this is going to influence bond yields as well, keeping cost of capital probably higher for longer than in terms of what people want. Jim Grant, venerated expert on interest rates, said that he thinks bond yields will be higher, not for longer, but higher for much, much, much longer. I think it was three muches that he emphasized. So anyways, let's talk about that a little bit. Now, I know you mentioned, we're not even just seeing that in the US, we're now seeing other countries. I think you mentioned before we turned on the camera here that uh, nobody would have believed this a year ago, but Japan's inflation rate is now higher than the US's inflation rate. So this inflation risk doesn't appear to be getting reflected yet in US stocks. Do you think that shoe will have to drop at some point, or is there an argument for why US stocks can continue to shrug that off?
Yeah, so I do think it's not priced into financial markets or the stock market at this time. And as you pointed out, the inflation rate bottomed in September, has been trending higher. And even though we might have a dip here in the February inflation number that gets reported in a couple weeks in March, we do think that the inflation rate is still trending somewhat higher over the course of the quarters ahead. And what we think that means is that the Federal Reserve and these other central banks are not going to be able to be as helpful from a monetary policy standpoint as investors might hope. And what that leads to is if you have more restrictive policy out there, that allows more time for difficulty with lending. Something else could go wrong in the overall economy, and the central banks are not there to help out immediately because they have to still be worried about the inflation rate. It removes that assistance that we think investors have been relying on for years. And so we think that's part of this that we really want to pay close attention to, is that the stimulative part from a monetary policy framework is gone.
Okay. So you've got that. I want to bring up one other of your charts here. Let me just find it, but it was with uh, bond yields. So obviously, bond investors don't like inflation, right? And if they think it's going to be around longer than they want, they say, look, well, you got to pay me higher yields to compensate me, right? So I can get a better real yield on it. So you've got this chart here that basically compares the rise in bond yields that we've been seeing since the Fed started cutting rate to previous rate cutting cycles for the Fed. And it looks like this one is surpassing all of them so far in terms of how quickly the long end of the bond yield curve has basically gone in the opposite direction. So what kind of complications is this potentially introducing?
We think this was tied to, I mean, the Fed started cutting rates right at about the same time the inflation rate bottomed. And we don't think they were realizing that inflation was going to stop decelerating and start increasing. And now they're finally starting to admit that they need to have a bit more of a balanced approach between focusing on the labor market and the inflation rate. So we think they're going to be more balanced, but the bond investors kind of spoke for them in shooting long-term treasury yields higher, suggesting to the Fed and some other central banks that they need to be more focused on inflation. Because it wasn't just the US Treasury market we were seeing this with. You've seen the jump in the 10-year Japanese rate. You see it over in Europe. So it's something that you're seeing in major markets around the world. And one other point related to this movement in the inflation rate and inflation even being higher in a place like Japan, you're starting to see the US dollar weaken a bit relative to other currencies, which we've had this commodity strength and these businesses with exposure to commodities performing well now for some time. And that's with a strengthening dollar. Now we could flip to where we have a little bit of a weaker US dollar market, which for a US investor investing in some of these commodities might be an additional positive that you're able to get even some more return during this period.
Okay, so on that point, then an analogy might be like a boxer who's, you know, boxers would oftentimes get in the pool and they'd be punching in the pool to have the resistance of the water, right? So when they got out of the pool, they didn't have that resistance and they could punch even faster, harder, right? So it kind of makes me think like you're thinking that might be that way for commodity investors right now, which is they've actually been doing okay with the headwinds that they had with the strengthening dollar. But if the dollar starts actually weakening, that may actually start flipping a headwind into a tailwind, and it could be maybe kind of fun for a bit as a commodity investor.
Yeah, I think at the very least it's worth attempting to participate and see if that really that upside to downside can be really skewed in your favor. And we've already seen that somewhat in some areas. Gold's obviously and silver have had a very good run, and some of the companies exposed to that. We've seen it with some of the energy businesses like the pipelines. And we're starting to see a little bit of movement in some other commodities. And we've tried to make sure we have some exposure in those areas as well, whether it's to agriculture or iron ore, really trying to make sure that we've got some investments, not just in the areas everybody thinks of, like a gold or oil. Natural gas was another one that we wanted to make sure we had some exposure to that we really want to monitor closely and see where that goes because it's been a good run so far and certainly could continue.
Okay, so I know having talked to you last year that commodities were a part of your portfolio. Are you at this point more sort of letting what you have ride and just watching it closely with some excitement, or are you actually increasing your portfolio allocation to the commodity sector?
Mostly letting it continue to run. We've added a little bit here and there, but I'd say most of it has been in place for some time. And there's been a couple of places where we've trimmed or sold where we just think the move was more than good enough that these are not super growth businesses. There is still a ceiling to how far they can go.
Yep.
But by and large, I think just continuing to hold what we have and just to the point that I'm sure some of your other guests have talked about, there's just changes happening under the surface. You mentioned Jim Grant and where interest rates are going. We might have had the end of a bond bull market in 2020, and now we're 4 to 5 years into a reversal, and interest rates tend to move in 30 and 40-year cycles. That has impacts on other parts of the market, whether it's secular growth businesses or commodities. So we're trying to make sure we stay balanced and really be respectful of these trends that can last multiple years, commodities being a part of that.
Okay. All right. So what I've taken so far from what you've said, given the current market conditions, stocks pretty darn rich. So you want to really be selective in terms of looking for much better valuations. But I hear you said there's really not that much that's like on sale right now. So my guess is reluctant might be too strong of a word, but you're not an aggressive buyer of individual stocks right now. T-bill and chill still works for the time being, right? You can still get a pretty decent safe return. Fed has basically stopped cutting for the foreseeable future because of inflation, right? So you don't have to worry too much about those rates coming down anytime in the near future. And commodities, a plus for the reasons you just mentioned. So bonds, you would think, given the comments that you just made about bonds, that you guys are probably kind of skittish about going out on the long end of the treasury curve, at least. Presumably, that also applies to corporate bonds, which have even additional risks as part of them. But don't let me presume. What are you guys currently doing around bonds in your portfolios?
We've got small positions in the long-term treasury. That's a new position. We've got just a little bit of exposure to a few high-quality corporate bonds that are companies that we know well that we might buy a 5-year corporate bond with a 5% yield just as a way to try to get a little bit of an increase on that 4% risk-free rate. But by and large, the vast majority of our fixed income exposure is in US Treasuries with a maturity of 2 years or less. And that's really the focus because we do agree with those that think that we're in a different time now in regards to interest rates. The trend is moving higher, and there will be stretches where you might get a break lower. Whenever you see the 10 or 30-year Treasury yield get up towards 5%, you do see these moments where it'll come back down by 50 or 100 basis points. And we think we might be in a bit of a short-term period like that, but you really have to trade those opportunities rather than just buying and holding them like you could have from the 1980s all the way up until 2020.
Got it. So is the relatively new longer end duration U.S. Treasury uh, position that you just mentioned, is that more of a shorter term trade because you think rates are coming down in the very near term
Yeah, shorter
or
term.
yields are coming down? Yeah.
Yes, yes. Shorter term, I think the idea there is that right now so much optimism got priced in there, and there's just a lot happening and a lot moving within the economy and policies and uncertainty that it wouldn't take much for something unexpected to occur, that something just breaks and you see a short-term drop in interest rates like you saw on Friday, February 21st, when you saw the stock market go down significantly and you saw bond yields go down. And you might have a stretch there here in the near term where that extends for a bit, but we're only trying to do it for a trade, and then we would stick to our core positions of those short-term treasuries and commodities and things of that nature.
Okay. Well, we've had, as you said, 2 great years in the stock market, right? Back to back 20+% years. And then it's sort of like somebody took the snow globe and just shook it up, right? With the new administration coming in and a completely different playbook than the previous administration. And I think it's fair to categorize Trump's first 30 days in office as aggressively disruptive. So again, that's the shaking of the snow globe here, and we're all waiting to see, what'll happen as the things begin to even out, if they do. So you have a lot of that uncertainty in the mix here. So I want to get your thoughts on the implications of the Trump 2.0 administration as you guys at Oxbow understand it so far, noting that it's still really early days. And then that creates an uncertainty risk, right? There's a lot of things that the Trump administration, a lot of surgery it's performing, probably a lot of things it's breaking on purpose to hopefully replace with something better. But the something better isn't going to arrive tomorrow. It's going to take some time, right? So there's risk there, which the market doesn't seem to be pricing much of that in right now. Secondly, so far in this conversation, neither you nor I have mentioned the word recession. And presumably, you've outlined a whole bunch of concerns that have nothing yet to do with recession, but if a recession were to happen, then obviously would exacerbate a lot of the concerns you're talking about here. So I'd like to get a sense to where you think we are, sort of economically speaking, and if there's a risk of a slowdown or even a full recession at some point, anytime concerningly soon, that we should at least be factoring it in somewhat to our portfolio strategies. Why don't we start with the Trump side of things? What implications are you guys expecting from what we're seeing here?
I don't think it's difficult for, I would say, anybody to say with certainty where things are headed. One thing we do notice is that it does seem like players in the market have become desensitized to these announcements. So I can remember the weekend where those announcements occurred with tariffs regarding Mexico, Canada, and China, and there was significant movement in the stock market and the fixed income market the next day. Now, when an announcement,
and the tariffs were pushed off by
exactly.
the end of that next day. So I mean, the game just keeps changing. Exactly. Yeah.
Exactly. And I think because sometimes it might be a negotiating ploy for a different tactic. Now, unless something significant that's far-reaching, like the aluminum or steel announcements, that's not going to hit the whole market. It's got to be something far-reaching, and it's got to actually be enacted and go all the way through. We think it's going to take something like that for markets to really adjust. So it goes back to your point about uncertainty. We don't necessarily know what's going to happen. We don't have a prediction that a recession is coming. But you look at what's priced in and just say that's too far on the optimistic side, and that's why we've positioned ourselves. We've got so much in short-term treasuries. We have a stock strategy that's in lower beta, more consistent companies, so that if there was a recession where you saw significant earnings revisions to the downside, we own a lot of companies where we think their revisions would be significantly less impactful and they'd hold up better. So we've already positioned ourselves, even though we're not saying a recession starting next week, we're positioned that if that occurs, we think we're better placed. And given those, we just talked about commodities. If there was a true recession or something hit the global economy, commodities would be hit, but we have procedures in place where we want to make sure that any riskier positions that when we add them into the strategy, if they're down 20 or 25 or 30%, we need to make a decision. We either need to double that position in size and really think that this is going to turn around, or most of the time it just means that this is one that's not working and you need to take your losses at that sort of lower level rather than trying to hold on and hope, and then it can end up being down 40 or 50% and you're really stuck. We think that's something that the average investor doesn't handle properly is you're going to be wrong a number of times in your portfolio. Not necessarily, might not even be your process. It might just be something unexpected that happens. But if something's not working, it's okay to take it out, reallocate somewhere else. So that's in terms of your positioning and thinking about recession. The final point on the recession is with what's happening with Doge and how they're trying to really focus on making the government more efficient, trying to pull back on fiscal spending. The government spending aspect of our GDP here in the US was a significant driver of growth in recent years. And if that's not going to be a significant driver, that could end up being a reason why GDP growth here in the US comes in significantly less than that 2.5% rate we've been hitting recently.
Yeah, yeah, no, that's definitely it's so interesting. And of course, you would say, well, that's not a reason not to try to find cost savings, right? But it's one of those transitional costs that we would just have to pay to hopefully get to a better destination there.
Mhm.
All right, so a couple questions for you here. Uh, First question is I don't think it's your base case that a recession is going to happen this year, although correct me if that's a wrong assumption, but you guys are cautious, right, as you've outlined. What indicators are you guys watching to try to get a sense for if trouble is beginning to arrive, right? Like credit spreads is a very popular one among most of the folks I talk to. What are the indicators you guys are watching closely?
Sure. So I would say the better way to put it is we're prepared for a recession. We're not necessarily predicting one,
Hmm.
but we definitely have our portfolios prepared in such a way that we want to minimize the downside if that did occur. Um, in terms of what we track, there's all sorts of surveys or things like that that come out on a monthly basis that are interesting to follow. But sometimes it's really useful just to see what's happening in the markets themselves and what's moving. And a couple of things that we've noticed real recently that have been happening is the home builders or the home construction industry and the transports. So the Dow Transports Index, those are more cyclical parts of the economy that when they start to turn and roll over, they usually don't just stop and start accelerating up again. Usually means that a different part of the cycle has become. And if you go back from their peak a few months ago, the home builders are down 30%. The home construction industry at large, if you want to include the building products companies and the home improvement retailers as well, is down 25%. And transports are down 10 to 15% just here real recently. So that tells us that things are happening under the surface that if they continue downward, and a good example would be a company like Builders First Source, which is a good building products company that supplies all the home builders around the United States. It's already come down in price by 30 or 35% to a level that we would say, if you're just taking their earnings at face value, is pretty fairly valued stock right now. But if you look at how wide of a range it trades in, that stock could easily fall by another 40%.
Mm.
That tells you how much downside there could still be left in the home builder, home construction industry. But we're already kind of about halfway down. And so it's going to be interesting to follow those sorts of industries to tell you if there's something really happening under the surface that maybe people aren't noticing because they're so focused on the top 10 or 15 companies in the index that are more in the technology space.
Hmm. That's really interesting. So these are cyclical canaries in the coal mine, and it sounds like several of these canaries are beginning to keel over. So that it is worth paying attention to. Just as an anecdotal example here, I put out a tweet on X over the weekend about a friend of mine who works for a large US furniture manufacturer and retailer. And he's worked there for decades as a salesperson and says the company's going through a slump right now that's the worst he's seen in his multi-decade career there with the company.
Wow.
And that tweet may be the most viral tweet I've ever had. And I wasn't expecting it to be, but it clearly hit some sort of nerve or resonated with enough people that it just sort of exploded. And there's a ton of people piling onto that, many of whom also work in the furniture industry or other real estate related industries who are saying, gosh, I'm seeing the exact same thing. So it definitely doesn't just seem to be one guy's personal experience. It definitely seems to be an indicator of where the industry is going. So anyways, I just mentioned that because I was shocked by by how viral that thing went. And to me, that's sort of an indicator that, yeah, there's something here beyond just this one guy's personal experience.
Yeah,
Um,
definitely.
all right. So the other question I wanted to ask you here is uh, we have your partner, uh, Ted Oakley, on this channel from time to time. People are huge fans of Ted for all the reasons you know are well deserved. He's such a great gentleman and such a wonderful mind and a very long career in the space. So he has a lot of wisdom built up from that. Can you describe just briefly what it's like in your portfolio management meetings? What's the interaction like with you and Ted? How do you guys determine, when to proceed with the decision, whether to keep sitting on it until you feel better about it? How does that work? How is the
Yeah.
sausage made there?
Yeah, yeah, no, I think we both have a similar view about paying attention to cycles, taking a longer term framework. We're not trying to win the quarter or something to that extent because we know just how much competition there is in that area. Um, each of us has a lot of focus in different parts of the research world. I would say between him and myself, he's probably a little bit more the pessimist. I'm a little bit more the optimist, but that
Mhm.
balances each other out well. But always very interested in just trying to really focus on taking away biases in our analysis. I'd say really just focus on just trying to be objectively what is the best assessments of what's happening right now, where the world's headed, um, and really trying to pay attention to um, getting the best possible upside while keeping our downside minimal. And I'd say Ted does an excellent job of capturing changes in a cycle, especially in the commodity front, where he's able to capture something early in the momentum that's starting to move and see an opportunity there. I'd say for myself, I like finding things that have been weak recently and are starting to hit a more undervalued level. And yet you still know the fundamentals of the business are intact and you can rely on that showing through over a longer term time horizon. So it's really been a fun partnership trying to just find opportunities. Sometimes there's a lot out there and I can remember stretches in 2018 and 2020 when there was just a lot to choose from, and there was not enough room in the portfolio for how many opportunities were out there. And then there are times like today where it really pays to make sure that you know what your downside is and where you could be wrong, just because you know how far things have gone in the last couple of years.
Does this feel like the other end of the spectrum in terms of periods where there's just so many fish to try to get in the boat because you see so many opportunities? Does this really feel like you almost don't want to put your hook in the water because there's just nothing worth catching?
Yeah, and you've got to participate because what ends up happening is there are still parts of your current portfolio that need to be sold, either because it just didn't work or it worked really well and now it's significantly overvalued and the fundamentals are rolling over and you need to sell. So if we're staying about half invested right now, there's got to be some new opportunities you add in. What's changed is just for instance, in the long-term growth stock portfolio, we were buying the full position sizes that we wanted in new stocks in 2023. And then over the course of the last year or so, we've basically been buying about half of the position size that we want and then leave room if we do get a bear market or a move
Hmm.
downward where we can double the position. But the prices that we're getting for what we're currently buying, they're reasonable. We think we could get a 10 or 12% expected return, but you're not expecting a 15 to 25% return a year on some of these. So you really want to be mindful of that in terms of how you size the positions that you do take.
Okay. Yeah, and it's probably been about a month and a half to 2 months since I've interviewed Ted, so I can't speak for his point of view today, although you can much better than I. But obviously, one of the benefits you get working with Ted is Ted's decades of experience, having seen many different market cycles. And my interpretation, from talking with Ted is he says, look, there begins to become a risk threshold that once you cross, you just realize it's so much better to be defensive than offensive. And rather than stretching for those, whatever nickels in front of the steamroller, yeah, maybe you're giving out on some of these late stage gains, but you're not putting yourself at risk of what can happen if the market really does turn and have a sizable and perhaps violent downside repricing. And he's just seen the carnage that that creates in investor portfolios. And he's much better saying, look, if we've crossed my threshold, I'm just happy sort of playing it safe, right? You're nodding as I'm saying all this. And one of the things that Ted has really imparted to me is that he's like, we haven't seen a bear market for a good long while. Not 2022, really probably not something since back in 2009, really. Because he said a true bear market is categorized by capitulation, which is people eventually end up not ever wanting to own a stock again. And that is sort of a good behavioral economist's indicator that, you know what, the washout has happened, and maybe this is a good time to actually start deploying again. And FOMO still seems to continue to carry the day to day. I guess my question for you here, Chance, is what's your sort of default assumption here? With valuations as high as they are, presuming something magical doesn't happen to justify, another big bull market run, will this just kind of be sort of a sloppy, choppy period ahead, or do you think the probability is higher that we're actually going to see some sort of correction, something that breaks the FOMO, breaks the sentiment, and maybe begins to put us into more of a true bear market?
Yeah, well, bear market in terms of the definition of what people call like a 20% downturn. I know Ted's spoken before in recent months about this could be the kind of year where you could have multiple 20% down, 20% up. So it'd be choppy, but choppier with wider swings, just because there's already so much sentiment skewed towards the positive side that if all of a sudden some things happen that make people think more negatively, it could really move things. And I think that's also some of the players, big players in the stock market now. Movements just happen faster. It seems like momentum picks up on the downside when things really get going. And you can see that in some of the downturns we had in 2018. That was a bear market in terms of numbers. It was a 20% down market in 3 months. In 2020, it was a little over a month. So it can happen quickly. And so I think we are prepared for that this year, where you could have a year that the market's essentially flat, but have multiple significant swings up and down over the course of the year. And what we would do in that scenario is, it's why we're positioned the way we are today. We'd be ready to put a lot of that cash and short-term treasuries to work. And then if you had a significant jump back to where we're looking overvalued like we are today, we would take some of it off and get back to positioning where we were. In terms of the true bear market that Ted likes to talk about, the factor that people don't think about with that type of a bear market is the time. You're talking multiple years, 18 months or longer, that things are just down. You get a short-term rally that looks like things have turned around, and then you go down to a new low. And that's what washes people out, turns them very negative. They think they just don't see hope for a turnaround. You saw that in 1973 and 74, 80 and 82, the dot-com bubble that didn't make a final low until March of 2003, and then 2007 to 09, like you were talking about. And it's been 16 years since we've had something like that. And I think a lot of people in the industry and just anyone in general who've only come into money in the last 15 years, I've never experienced what that's like, where the buy the dip mentality no longer works. And you got to really know how to handle risk and position your portfolio if you are going to have a drawn out bear market like that.
All right. Well, look, this is why I recommend so frequently on this channel for viewers that are concerned about the potentiality of that happening to go work with not only just a good professional financial advisor who can help them, come up with a strategy, but one that has the experience in their staff of having ridden through these cycles, right? So that you're not riding somebody who's figuring it out in real time for the first time, right? So let me ask this, just for the people who are watching, saying, Adam, stop, being so bearish in your questions and bringing on perma bears all the time. Let's assume for a moment that the market actually ends up performing great again. We have another 20% year, and 2026 is a fine year too, right? What are the leading contenders right now, do you think, that could prove you wrong? For your baseline thesis to be wrong, what do you imagine would be the thing that proves you're wrong?
Imagine it would just be that nothing breaks and we're able to kind of hold this middle ground. It's maybe something that people don't think about. We focus on the rate of change with inflation, and we talk about how inflation has been moving higher. But a 3% inflation rate, if it just stayed at 3% static, that's not the worst thing. Risky financial markets have performed just fine if it just stays at 3% and you don't have anything break in the economy or a financial market around the world. So you could have a scenario where things just kind of hold steady and the cyclical economies pick back up. Optimism, especially small business optimism, starts to pick back up. I think we had a spike in small business optimism right after the election results, where they were thinking some deregulation would really help their businesses. Now, CapEx plans have come back down a bit because I think just how fast policies are moving and things are being announced has created a little bit more uncertainty. But if things even out again and that optimism resumes, you could end up having a decently performing economy and these cyclical businesses deliver on their numbers. The tech AI story really comes through, and there are really good uses for that the businesses can put to work, and that all happens the way everyone hopes. All those things could come together, and you could have another double-digit up year this year or next year. We just like looking at how things have performed historically and just know that when you've gotten to this level with where things are priced, that the odds are eventually that you're going to have a significant downswing. And if you don't mind taking on that risk and you want to stay fully invested, focus on cyclical stocks, that's perfectly okay. For our investors and the way we try to manage money, we always are going to focus on the downside and the risk first, and that's where we're really placing our interest at this point.
All right. Well, I appreciate that, and it's a great exercise to go through. Sounds like you guys gone through it enough that you had a quick answer to the question. I always think it's smart to be watching the things that could prove you wrong, even if you feel pretty confident about your default outlook. Okay, so in terms of positioning, we've already talked a lot in this conversation sort of about your general sentiment on each of the major asset classes. Is there anything else that you want to tell us about how Oxbow is positioning right now? And maybe in your answer, I believe it's Ted that says, I don't think it's really the era of 60-40 anymore. It's more like 30-30-10, I think is the way he sort of thinks about it. And if that's still true, explain what the 30-30-30-10 is.
Yeah, I think he thinks, and I think our firm-wide view is one of having more balance. And I think his concern with the 60-40 portfolio, it's that 40% focus on fixed income that also includes long-term oriented fixed income, where you could have real downside risk if rates continue to move higher, similar to how they did from the 1940s to 1982. If you have a bond bear market that lasts years and years into the future, that 40% allocation to fixed income is going to be a tough place to be, and you're going to be really reliant on the stock portion of your portfolio. So we just view that you're going to need more balance, and including some other asset classes like commodities, and having an allocation to oil and natural gas, an allocation to precious metals, along with some other commodities, whether it's more base metals like iron ore or copper, or the agricultural space. Having a little bit more of a well-rounded view, I think, is going to end up being a better way to allocate your portfolio for the years to come, just to mitigate the downside and still hopefully end up having a satisfactory return.
Okay, and just to make sure I got my notes right, if it is 30-30-30-10, is it 30 stocks, 30 fixed income, 30 commodities, and 10 T-bills, or what's the 10?
I believe it's just the short-term cash. I
Okay.
put that on that one, but yeah,
Okay.
it's not something that I think we're not trying to have it be so regimented, like, oh, it has to be 30% of each. I think it's more just making sure that people are considering, and it's a moving target. There are times where, like right now, our high income strategy is 25 to 30% exposed to commodities. But if we were about to have a global recession, I'm pretty sure we'd be pulling down that percentage because there's a lot more downside in that scenario. So it's more just trying to explain to get beyond those simple two asset classes, that it's going to require a little bit more sophistication in how you think about allocating.
All right. And just one question for here about fixed income. So you've talked about some of the challenges as a capital manager dealing with that traditional 40% of the portfolio that is supposed to be the ballast of bonds versus equities. If you're if Jim Grant's outlook is resonating with you and you're thinking, okay, you know what, these things aren't going to pull as much weight as they have over the past 40 years, right? They've now got a headwind in front of them. I know it's multifactorial, but gold has been performing well recently, and there's a bunch of reasons for that. And the huge one is that central banks have been preferring treasuries, preferring gold to treasuries in terms of their purchasing. And obviously, the Eastern investor has been very active in buying gold. Um, are we are we starting to see other Western capital managers wrestling with this? What do I do with the ballast part of my portfolio? Because I'm now a little frustrated with where I think bonds might go. Are they beginning to peel a percentage or two of their fixed income allocation into gold as another safe haven ballast asset? And yeah, it doesn't pay a yield, but I'm concerned about bonds value going forward. So I'm actually okay with that as long as the thing is a holding value and maybe even appreciating in a world where inflation perhaps might be more sticky.
Yeah.
The reason why I ask this is there is such a colossal amount of money in the bond market. If even a small percentage of that were to trundle into the gold market, that could have a really big price impact in gold.
Yeah, yeah, we would agree. Although I don't think anyone who has an allocation like that, I think has been that way for a long time. And I don't think we've heard many people just real recently have decided to think differently and start allocating that way and really start having a core whatever percent position of the portfolio that's in gold. And I do think that's one thing that people think, oh, we need to have a huge portion of the portfolio in gold. That's not how we run things. It's a few percent, and then we try to maybe have 1 or 2% in silver, and then up to a handful of percent in some high quality gold businesses. But we think it's worth having some exposure there, given where we think the world's going. But I'm like you, I'm wondering if others are going to start to see things that way, especially some of these sovereign wealth funds or some of the really big money managers out there. But as far as I've seen, I haven't seen anybody making a publicly notified shift in that direction.
Okay, so you're not seeing it as a real industry movement now. And just asking you to speculate, I won't hold you to this,
Yeah.
but just guesstimating the next 5 years, do you think more will or not?
I would think more will. People tend to try to catch on to trends. We've got gold nearly hitting $3,000 here an ounce, and so that might be that number, or maybe it's somewhere somewhat higher that it starts to really trigger in people's minds that they need to participate, and that might be something that drives the momentum further. But so far, another way you can think about it or look at it is. You could try to allocate to some of the gold businesses out there, but we're not seeing that either. And it might be something as simple as those really aren't a factor in the big stock indices that everybody buys, if you
Right.
think about money going passive. So, yeah, right now it's not really the case, but it would be an additional positive. Right now, it seems like the incremental buyer that wasn't there 20 years ago is the central banks and governments around the world.
All right, Chance. Well, look, I got to start wrapping up here. Always a great discussion with you. Thank you for doing your usual excellent job here. Big fans of you, the whole team at Oxbow, Ted, obviously. I know Ted's got a new book coming out, folks. When it does come out, I'll have Ted back on and we'll go through his latest market outlook at that time, but also we'll go into the depths of the topic of the book. Um, for folks that have really enjoyed this discussion, Chance, and would like to follow you and your work, where should they go?
Yeah, you can look at our website at oxbowadvisors.com, or our team's created a really good YouTube channel. If you just search for us on YouTube at Oxbow Advisors.
All right, fantastic. And Chance, when I edit this, I'll put the links on the screen here so folks know exactly where to go. Folks, I'll also have the links in the description below the video so you can get there with just one click. Chance, stay with me just for 1 second. I got like 30 seconds of housekeeping, and then I want to give you the last word here. Folks, if you've really enjoyed having Chance on, would like to have him come back on the program again in the near-term future, please let him know by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. And obviously, if you are trying to figure out how to navigate this market, If you'd like to talk to the guys at Oxbow to do that, especially if you're a high net worth investor, that's their specialization, then go to oxbow.com, talk to the team there. But also, if you are looking for inputs from a good financial advisor who understands all the macro risks that Chance and I have been talking about here today, in addition to potentially talking to Oxbow, you obviously can schedule a free consultation with one of the financial advisors that Thoughtful Money endorses. And these are the firms that you see with me on this channel week in and week out. To do that, just fill out the short form at thoughtfulmoney.com. Reminder, these consultations totally free. There's no commitment to work with these guys. It's just a free public service they offer to try to help as many people as possible, position as prudently as possible for what may be lying ahead. Also, while you're there at thoughtfulmoney.com, don't forget to go to thoughtfulmoney.com/conference and sign up for our spring online conference, which is coming up now in just a little over 2 weeks. So that's going to be Saturday, March 15th. And a reminder, you only have a couple days left just until this weekend to lock in the early bird price, which is the lowest discount price that we're offering tickets at. So run, do not walk. To thoughtfulmoney.com/conference, buy your ticket there, lock in that lowest price. And if you are a premium subscriber to our Substack, you get an additional $50 off of that price with the code that I've already emailed you. And a reminder to everybody, if you can't watch the day, the event, the day of the event, don't worry. Replay videos of the entire event will go out to everybody right after the event concludes. Thanks for your patience, Chance. So very quickly, the people that watch this video, for the most part, yes, we have a number of professional investors who watch it, but most of them are just regular people, all right, who are just trying to build wealth. They listen to a guy like you and say, oh, it looks like it's going to be kind of a rougher year ahead. I don't want to get wiped out if the market does some crazy things. What would just sort of be your parting counsel to the regular investor in a year like this one?
I'd say sort of good habits. I mean, just, if you're still in the point of your life where you're still saving and building up your wealth, just continue to focus on the saving and making smart decisions. And really, if this ends up being a more choppy and volatile year, and if there is a significant down year ahead, just making sure that you kind of know your long-term goals, that you've got a plan that you're building right now, that if the value of the stocks you've got goes down by 30%, don't sell at the bottom. You want to be able to know that over a 10 or 20 or 30-year time horizon, this is going to turn out okay. And just be ready for those tough decisions if you end up in a very more difficult market than we've had the past couple of years.
All right. Well, wise counsel. Chance, can't thank you enough. Thanks so much for coming on. Great discussion. Really look forward to having you back on in Q2.
Yeah, thanks a lot, Adam.
All right. And everybody else, thanks so much for watching.